So, hello and welcome. Just going to be going through a few different masterclasses over a few weeks, really just to help anybody out there that can they're going to be either struggling with finances, because I know we're in a bit of a difficult time, but also just to get the kind of the basics underpinned. Really, as a lot of it doesn't need to be too complicated. I'm just going to work through a few things, and hopefully it helps you out. So, just to jump straight into it, then. So, what I'm going to be covering off today, working from bottom to top, and I'll explain why in a moment, is budgeting, a little bit on emergency funds, insurance and kind of what it is, retirement and retirement planning, investing and saving, mortgages, wills, and LPAs or lasting power of attorneys. So I've done it in that order simply because the foundations that kind of get built from when you structure your finances a certain way, and when you have them in that pyramid that I've put there, it means that you've got a good solid foundation for everything else to really kind of build upon. So that'll come more clear as we go. So budgeting as a whole then. Firstly, just keep it simple. It doesn't need to be really complicated. It doesn't need to be a kind of a stressful task. And actually, if you do get into a situation where you're getting really stressed about it, you're probably not doing it quite right. It needs to be something where you have an outlook on it that's I'm in control. So if you get in a position where you can note down what your income is and what your outgoings are, it puts you back in the driving seat rather than sitting in the back of the bus and somebody else driving you crazy around the streets. So first things first is figure out your monthly income. So for some people, this might be really straightforward. It might be as simple as, right, I get a set salary every single month, so I know exactly what comes in. And whatever you get net, which is after tax, you write that figure down. Could be as simple as that. Now, for the people that are paid hourly, commissions, overtimes, for instance, like NHS staff, things like that, where you might have, or even paid weekly, this can be a little bit more complicated. So, as a simple way to do it, I always say take an average of what you can. So, if you know that your overtime in the last 3 months or so has been quite high, perhaps be a little bit more conservative and just lower that down, because you want to make sure that you're erring on the side of caution with what your income is going to be. If you're paid weekly, then I always say if you can, because most bills come out typically on a monthly basis. So if you can try and factor your weekly budget to fit monthly, then it kind of works. But if you can't, you just do with what you can. It's simpler to budget on a monthly, I find, and it becomes less of an arduous task. Having to do it every week is a bit more of a pain than it is having to do it every month. So just want to sort of think about. If you're then calculating your outgoings, again, you're going to have outgoings that are going to be yearly, some that are monthly, some that are 4 weekly, depending on what they are. So, or some even like 10 months, like council tax and things like that. So calculating your outgoings, the ones that come out monthly, simply, you just note them down against your income. If you've got ones that are 10 monthly, you can actually average it out over the 12 months. But I always used to just like to think, well, the extra 2 months is almost like a bit of a bonus and you can put that money aside if you need to, but just assume that you'd be paying it for the whole year. And then for yearly outgoings, or what I like to try and set aside, is something called a sinking fund. So a sinking fund is where you put all of your kind of bills that you are expected to pay for the year, and you essentially put them into a pot so that when you are ready to pay those, car insurance could be yearly, house insurance, you could have MOTs, you could have, you name it, any kind of yearly bill that you think that you might need to pay for, because ideally a lot of bills work out cheaper if you can do them that way, where you essentially put in a savings account or just in a normal current account, just tucked aside, that you put your monthly amount of whatever you need to put aside to accrue the whole yearly amount. So in simple terms, if it was £100, you divide the 100 by 12 and you put that aside every single month, so that when that yearly bill comes round, you know you have a slush fund to be able to use. And if you do this with all of your bills, whatever those yearly ones are, and divide it all up, and you build up a rolling pot then. So it's not always going to be full to the top. It's going to be times where there's going to be bills coming out, it'll drop back down, and then other ones that'll sort of pick it up from there, and it'll kind of fluctuate. But what this does means that you're in control of when your yearly bills come out, and actually it can save you a small fortune, because car insurances, house insurances, things like that, can actually charge you a little bit more for the privilege of just paying for it monthly. So if you can regulate the monthly payment yourself, you're onto a winner, really. And it also means that you've got the money set aside to pay for those in one lump sum when they come about. So hope that makes sense. Next is the actual budget planner itself. So I've got a budget planner that I use with clients. It's a fairly simple one. I've got one that I use personally, which is more complex for myself, but I don't like to make it complicated. You've just got to keep it simple. Again, you don't want to put resistance and friction there because you're just going to cause yourself a headache. You want it to be nice and simple. So as I put at the top there, a notepad and pen still works. It doesn't need to be in a spreadsheet. It doesn't need to be done in a crazy graph or a chart. You can literally just draw a line, put your name at the top, put your, probably don't need your name at the top, but put your income at the top, and put your outgoings listed down, and then just get a calculator or your phone and just calculate the difference. It can be as simple as that. If you use a Excel sheet, and you might start wanting to use this if you are doing it consistently, because it can save a bit of time, and also then you can essentially copy and paste each spreadsheet each month that you need to be able to not constantly keep replicating and keep writing it out. You've got almost like a template for each month. So again, simply all you do on this is put your income in, and you might have other income. There might be child benefit, there might be other maintenance payments you receive, might have bonuses, all kinds of different things that fluctuate slightly differently on a monthly basis. List as many of your outgoings broken down as you can, and also your sinking fund payments. And then obviously the difference is your surplus or your deficit. And if you start doing this, it really puts you back in the driving seat and in control. So following on to getting yourself back in control is emergency fund. So emergency funds are quite a kind of a misunderstood thing, really. They are quite simple in what they do. It's essentially just your own pot of money instead of using a credit card. So if you had an emergency, the boiler breaks, the car breaks, a hospital journey you needed to do, something that was quite severe and an emergency, you can utilize this because it's your own money, and your own money is your cheapest money, instead of having to snowball the potential effect of accruing more debt by putting it onto credit cards, which is not ideal. So few ways that emergency funds are used. The first thing I always say is aim for £1,000. If you've got nothing, you've got zero in the bank at the moment, aiming for £1,000 is going to help you just give you a figure to aim at. You think, well, how much do I need? Just if you get £1,000 behind you, it essentially helps you, one, have a goal, and two, it's a figure to work to, and three, it just gives you, or takes away, a bit of anxiety, essentially. So by having that £1,000 that then you can build upon, and it forms a bit of a backstop. So if you save that first 1,000 and then something happened, like the car broke and you needed to use it, it might feel a bit disheartening to use because you worked hard to save it. However, that's a lot better than it would be putting it onto a credit card, as an example, which then accrues interest. You're then going to have to try and pay that off over a period of time, or take it at your next month's pay, and it just starts to get a bit of accrue a downward spiral, really. So you really just want to try and get that settled as quickly as you can. Any emergencies that you have, and I always say it kind of turns an emergency more into an inconvenience, because it's inconvenient that you've got to use your own money, as opposed to a panic of where I'm going to get this money from. So if you can, as long as it takes, £1,000 a good starting point. Then you look to, once you've got this, your next thing, which follows on from calculating your budget planner, because if you know what your monthly expenses are, you can then actually calculate your times that by 3, and then you've got an easy figure to work to as your next target, your next goal. So 3 months means that if you got made redundant or you was off sick for some reason, you've got 3 months worth of savings covered. You don't invest any of this money, you don't tie it up, you don't try and get a return, it's simply just held in cash. That's what it's there for. If you're at the point of nearing retirement, I always say it's better to have a little bit more if you can. So 6 months, a year, some of my clients I speak to, I even get them, we even got savings, or even shifted some of their investments around so that they've got a year to 2 years worth in savings, just held in cash. And that's purely for the fact that if the market's going up or down and they need pensions to live off, they know they've got cash as that stable income as well, and it creates a bit more of a consistent retirement. But kind of getting ahead of myself, 3 months is the next goal. And then if you can build up to 6, you'd be surprised once you have 3 to 6 months worth of outgoings in your bank account. It puts you in so much control that either you stop dreading as much going to work, it helps take anxiety out of just day to day, because again, it turns things from an emergency to an inconvenience. And also, if you don't quite get on with your boss and you decided you want to leave, you're not having to try and tee up a new job straight away. It means that you could go, actually, I'm going to be okay for a month, and this is causing detriment to my health and my well-being. So you can kind of just go, I'm leaving, and you could drop things, and it means that you can actually use that money for a month or so if you really needed to then set yourself up in line for a next job. So lots of different reasons to have it, and I hope that's kind of made sense. Right. Another kind of top tip, really, if you're couple living together, married, got a mortgage together, however your arrangement may be, a real key fundamental to think about is if someone holds the emergency fund in the couple in one bank account and something happened to that person, their bank account, if it's not a joint one, will get locked. So the other person is going to be left without any cash or capital to use in those emergencies. So even if you operate your finances separately, completely separately to each other, so that you don't need to, share bank accounts, you have a joint bank account, it's worth considering having one joint bank account where you hold that 3 to 6 months worth of savings, purely just for the event that if something happened to one person, it can't get locked because the other person still has access to the bank account. So it's just, again, peace of mind and helps take the anxiety out of situations. So next, we have insurance. I know for most people this is probably not the most exciting topic as far as all of these go, as what insurances are. But it underpins pretty much everything. So far we've built some. If you've done what we do so far at this point and you're revisiting this webinar to think, well, what do I actually need to do? Essentially, you've built a solid foundation so far, and the next thing is to protect what you've currently got. So you've done that through some emergency funds, some savings, but ultimately the next layer is there's bigger things. There's mortgages, there's your income, there's your health, all these different things, and you can't really progress and build upon wealth unless you're protecting what you've currently got. So that's essentially what insurance is in a nutshell, whether it's for your home or whether it's on yourself, life insurance, critical illness, many different ones. So why do you need it, or what's the purpose of it really? So as an example, if you are, again, off sick from work, you've got your emergency fund and 3 months you've got saved there. If you needed to use that sum for the car, if you needed to use some to pay for a couple of months of outgoings, you kind of have to ask yourself, what do I do after that? What do I do after that period of time where I've now, work's not paying me anymore and I've not got any savings? What do I do? If you've got other investments, okay, you might be able to pull those down if you've got any ISA accounts or any general investments, or if you're at an age where you can draw on pensions, you might be able to do that. However, you don't want to be forced to do that, because you might have to sell off investments and pensions at an unfavorable time if the market's not great, and you're going to be selling off more units. So a way to mitigate it, in the first instance, is things like critical illness and income protections. Income protection is essentially just funding your own kind of sick pay. So you have something in place that if you was off work for say 3 to 4 months, and you couldn't go back because the GP signed you off and says you've hurt your back, it could be mental illness wise, it could be many different reasons, you could have had something quite serious. Essentially what happens is the policy will kick in and it'll pay out a percentage. There's different policies, but I'm not going to go into the details of it, but different policies that can pay out an amount of your income. So it's like you're self-funding your own sick pay. And again, these policies mean that you're keeping up with your bills for your mortgages, so you've not got a risk of repossession. You're keeping your salary. If you're renting, you can keep paying the rent. You're not forced to move. All of these different things add on another foundation to help put you in control of your own situation, and sort of not have to potentially try and rely on the government that might not pay you what you need. If you've got too much in savings that you don't want to draw on, or investments, they'll suggest using those first, and it's not favorable to do so in most cases. So insurance can help mitigate this. And then you've got other things like life insurance, which most people recognize, to make sure that if things happen to yourself, your loved ones are looked after. So it's kind of like a love cover, really. You're not going to benefit from it, but you're the ones that you want to leave behind, potentially will if something happened. Helps cover against debts, helps cover against loss of income, critical illnesses. There's lots of different ones, but the main purpose is, and this is just to give you a bit of a flavour of how to structure the overarching your personal finances as a nutshell, really. If you do start looking at this and looking at things to have and what should I have, what shouldn't I have, not all insurances are built the same, so just make sure you do your research and make sure it's appropriate for what you need. Right. Next one. So retirement and pensions. So again, this is, you might be thinking, well, why is this coming up sort of now? I'm either too young. I don't feel like I need to sort out my pension as of yet. It's one that I've put quite early on because the power of starting early has such a profound effect. And even if you're at a point where you're thinking, I might start in a couple of years, or even is it too late to start, starting sooner rather than later or now, because the best time to plant a tree was 20 years ago and the next best time is today. So, and the same applies to pensions. So if you can start now, it has a massive effect, massive impact. So it gives you freedom ultimately. So if you're thinking it's too early, then it never is too early, because the compounding effect on pensions and the way that you get tax relief up front and the way investments grow over time, if you start looking at graphs and charts, or you even just put in a simple calculator, which you can put in links and send to people if they need to, and you start putting figures in, it has such a compounding effect on how your money grows over time. It will blow your mind. So starting sooner, even a little bit, will have a great impact at the other end. And if you're at a point where you're thinking, it's too late, what's the point of me even trying to save into a pension? Well, the fact that you get tax relief instantly the second you put money into your pension is essentially, if you're a basic rate taxpayer, you get 25% uplift. You're essentially getting a 25% return on your money straight away. So if you're even 54 and you could potentially retire at 55 and you're thinking, I've got some money, I don't really know what to do with it, consider putting it into your pension, because you're only going to have to wait a year, but you're going to get an instant tax release uplift. And then when you do retire, as long as you're still not working at that point, you can start doing clever things with your allowances to draw that down. So lots of different things you can do, but ultimately it's never too late and it's never too early. The best time is now, essentially. Other thing is, it's your money. So it's not, you might think your pension's held with your employer or Nest or Aviva or Royal London, lots of different companies. You might be thinking, it's held with them. It's still your money. It's your money to make work for you at your retirement. So don't think to neglect it. Make sure that you are keeping on track with it. And at least you've got a kind of understanding of it, so that when your retirement comes, it doesn't come as a shock and you've been planning and actually had that mapped out for a little while. Or at least if you don't want to do anything with it or move it or change it, just know what it's doing. It's your money and it's working hard, and you're putting money into it. If your employer is, because they're obligated to, or you are, it's still your money. Check what you're invested in. So even though you might think my pension's held with an employer, well, what your employer investing in, is it appropriate to fit what you need? Is it appropriate for the growth that you want to get on your pension? Is it too volatile? And if you checked it, it's going up and down and it's giving you sleepless nights if you did check it. So just open the bonnet and have a look at what type of investments are within your pension, because for a lot of clients I speak to, and why would you know, because you never get told, it's completely a shock to find out what they're actually invested in. If you're struggling to find pensions or what should I do with them, you can look to consolidate pensions. So if you've got lots of little pots or a couple of pots that you're thinking, I don't really know what to do with, you can look to consolidate them together so that it's easier to manage under one roof. And if you're struggling to find any types of pensions that you might have had in the past, then something else you can do is a pension tracing service. So it's through the government website. You have to have some basic information, and it's not the simplest, but it can help you track down a pension, or a financial advisor can do this for you. As long as you've got a policy number, really, and the name of the company, the rest can be hunted down by sort of a financial advisor that can do it for you as well. So many different ways to find out what you've got and to get a bit of an insight into what it's doing and what it has done. And then also not only just checking your pension, but what's your plan? What are you actually planning for your retirement? What's your retirement looking like, and what other provisions do you have in place? And one key one that most people forget about is state pension. So checking your state pension can have such a kind of for some people I've spoke to, quite a weight lifted, because thinking, I don't really know how I'm going to survive. But if you check your state pension forecast, firstly, you can check if you've paid enough credits in, and if you have and you're entitled to the full amount. For a lot of people, this does form a good solid foundation to their retirement because it's consistent. It stays for the whole duration of your lifetime, and it will keep paying out for as long as you physically need it. And then any other provisions that you build up on top will essentially create a more fruitful retirement. So whatever type of lifestyle you want, if you want an extra holidays, wanted to go away more, live abroad, different things, your state pension covers the basic, and everything else builds on top of that. And it really just depends on what type of kind of time you want when you are retiring, or even to potentially retire sooner, because state pension for some people is sort of 67, 68. Again, there's a calculator to see. You just put your date of birth in, and it tells you whether it's going to be 68, 67, or 68. But if you want to retire sooner than that, you're going to have to have your own provisions again. So it's putting yourself back in control to see what's the best thing to do. Other ways that you can plan. Don't worry about the lots of colours and the graph. It's just something as a financial advisor that I can use to help plan people's retirement out, or if they've got certain objectives or goals that they're wanting to achieve throughout their retirement, and to see how sustainable that type of income is. So it's great. You might have a 100, 200, 300, £500,000, £1 million pension pot, or £50,000, whatever it is. Depending on what you're going to take from that, it's only going to last a certain amount of time, even with reasonable investment returns. And this helps me as an advisor sit down and kind of visually show how that's going to change. Some people want to think, well, I want a one-off holiday and then I'm happy to live off the rest. Some people are like, I want to live off a consistent income. There's no right or wrong answer. It's just a tool that we can use to help map it out. Again, doesn't need to be that complicated. It's just something that I use with clients to help them plan that out, really. So the next one, following on from retirement, is investing and saving. Kind of fits similar to retirement as a whole, but your pension is a form of, it's called a tax wrapper. It's a way of actually saving and building up funds. Whereas investment you can do in different ways, and you might potentially have different goals for your savings or your actual investments than your pension. So your pension's typically for retirement, and your savings could be because you want to buy a new house, you want to sort of move home and upsize and want to put extra money in to be able to do that. It might be for children's university fees. It might be that you want a one-time holiday. You might want to buy a boat. There's literally no right or wrong answer to why you potentially want to invest or save. So these are to identify your goals. If you're in a position that you've kind of boxed off the other things, and you can start moving on to looking at any surplus money to save and invest, you can do this in various different ways, using things like ISA accounts, which are a tax efficient wrapper, and I'll show you in a moment the different types of ISAs that there are. And also, why would you invest and why would you put it into a pension if it can go up and down along the way? Well, the goal is that it goes up in the long term, but ultimately it's to outpace inflation, which I'm sure you've heard of on what's going on at the moment, and things generally in the economy and places we have been, and right back into 2008. And if you look at historic charts, inflation's essentially the reduction of the purchasing power of your money. So as goods and services get more expensive, you have to try and keep your money to keep pace with it. So if you had £100 that you put under the mattress for safekeeping, in 20 years' time, that £100 is not going to be able to buy the same goods and services today as it would in 20 years. So that's essentially, in a nutshell, what inflation is, and investing helps mitigate against that. And then what we want to achieve on top of that is a real rate of return. So not only just keep pace with inflation, so your money keeps its power and its purchasing power, but also grows on top. So these are the types of ISAs that you can essentially have. You've got cash ISAs, help to buy ISAs, which are no longer running. This you can get on my website as well. So if you go on my website and look on investments, you can actually pull this chart up if you need to look at it at a later date. We've got lifetime cash ISAs, lifetime stocks and shares, innovative stocks and shares, ISA by itself, and a junior ISA. And at the bottom there is actually a junior ISA. Just pop it up so you can see it. Junior ISA, but stocks and shares. So cash, simple. It's just cash. You might as well just use a current account in all honesty. There's not much point in putting it into an ISA account because the interest typically is so low unless you've got such a significant amount where interest is starting to be a problem. That means that you might have to pay tax on it and it's above your personal allowances and things, then you might have to consider it. But for most people, you don't. Help to Buy is a kind of legacy plan now. Some people still have these because they're still saving into them. It's for purchasing of first-time buyers. And it's quite at the time, very good and efficient way of getting a government bonus on top of your money to be able to facilitate towards a deposit. Lifetime ISA is the up-to-date and the sort of more snazzy version of a Help to Buy. But it can also be used as a retirement planning vehicle as well. So even if you used it for the purpose of purchasing a home, you can still have one. They're just rules, as you can see there. You have to be over 18, but less than 39 to be able to open one. And then you can pay into it and you get a 25% bonus uplift. Again, you might be thinking, well, why don't I do this? Because I can access it instead of a pension. If you were to compare using this to using a pension for retirement planning, a pension does outpace it. So that kind of answers that question. But if you're utilizing full allowances in pensions, then using a lifetime ISA can be a good way of topping that up and squeezing out what you can. Innovative Finance ISA, a little bit more complicated, but it's peer-to-peer lending. Most people don't really have to consider this anytime soon, but it's just a slightly more adventurous type of investment, of way of lending money out to get a return on it. Then you've got stocks and shares as a whole, which are invested in the stock market, bond shares, cash, property in different formats, as some of the asset classes that you can hold within a ISA portfolio and build this up. Different ways of doing it, but it's essentially just an investment account. And when you see the lifetime ISA and the stocks and shares, because there's two, cash and stocks and shares, it's because you can either have your lifetime ISA just in cash, or you can have your lifetime ISA within a stocks and shares. So just to kind of clear that up. And then also you have the junior ISAs, same format again, cash or investment, but the limits are different. So for on the right hand side, you'll see that your allowance is 9,000 instead of 20,000 that you'll get on an ISA that's held individually. A junior ISA is for children, as long as they're under 18, and you'll be able to put money into them for them on their behalf to build up, and then they can inherit that at a later date. So they're the types of ISA, probably a lot more than people realize that there is, and they can do different varying things. And then within that, you just need to decide what the best strategy is for you, whether you invest cash, use Help to Buy, lifetime ISA, or not Help to Buy, but lifetime ISA, whether you use even an innovative finance ISA if you're a little bit more adventurous. So different ones to consider. So next one is mortgages. So mortgages for most people is the means to being able to purchase a house, whether you're a first-time buyer or a home mover or you're currently homeowner. Mortgages for most people are, in a way, owning your home a lot sooner rather than having to save up silly amounts of money to be able to actually purchase a home. So if you understand a bit about a mortgage, it can help you, again, figure out if it's the most optimal solution for you. So is it the right mortgage deal? Is it the right term? Are you paying the right amount? So having a little bit of an understanding can be pay dividends, essentially. So what is a mortgage and how do they work? So a mortgage is a loan, but it's not like a personal loan. It's a secured loan, which means that the collateral is your house. So that if something means that you defaulted on the loan payment, they could repossess your house. That's fundamentally what it's there for. Now, whether you're saving for your first home and you're a first-time buyer, you've got those savings accounts and things. If you're wanting to make sure as a first-time buyer you've selected the right type of mortgage deal, it can be worth just speaking to somebody that's in the know, whether that's a family member or a parent that's done it themselves, or an advisor, mortgage advisor or financial advisor like myself that knows how to sort of hopefully digest this in a way that's understandable. because it can be a little bit complicated and there's lots of different terms and lingo and everything else that doesn't need to be there. But it's just making sure it's clear and understood so that you know exactly what your monthly payments are going to be, what your costs are going to be, the interest, the whole process of legal fees, and understanding how it works. And if you're a current homeowner and you've gone through that, it's considering, is it worth remortgaging and changing your actual mortgage deal? So can you change your mortgage deal now, even though you might be in a fixed product, and actually make a saving, calculating if there's any exit penalties and weighing that up? Or is it worth staying with your current lender and doing a product transfer if your mortgage deals come to an end? Because staying with your current lender isn't the be all and end all. There might actually be a much more cost-effective solution. And if you've got access to the whole of the market, or go to an advisor that has access to the whole of the market like myself, you can then go and sieve through this, make sure it fits that person's situation, and then you as the end client know that you get the best solution. So you know that you're going to get, for your situation, the top lender available, which means you get the most optimal interest rate, the lowest costs, the charges, everything else. It's not all just about the interest rate. So having a bit of an understanding can be really helpful, because there is costs and things that are related to remortgages, product fees, arrangement fees and things. So it's ultimately what you're going to pay per month or over the 2 or 5 year fixed period that you're looking at, not just what the headline interest rate is, because that could look great, but then if you're paying a few £1,000 in fees alongside it, which wipes out any savings, you need to look at weighing these up. If you're looking at thinking, should I pay down some? I've spoke a bit about investing and retirement and things. If you're at the point and you've got a mortgage and you're thinking, is it worth investing or is it worth paying off your mortgage? It kind of comes down to you, really. If you're at a situation where you're quite risk averse, then paying down on your mortgage is a bit more certain, because what you're essentially comparing is what you can save on your mortgage interest compared to what you can make from an investment. And if you feel that the investment, and obviously we have conversations around this, or sort of look into it a bit more, if you're confident that the investment long term, not short term but long term, could actually outpace the interest rate that you would save on your mortgage, then it might be worth investing even though you've got a mortgage. But if you want to have a bit more certainty and think, well, actually, I just want to know that it's paid off in a few years' time, or want to take a few years off it, paying it down and running a few calculations on it, you'd be surprised how much interest you could save, because it could be tens of thousands just by making an extra £50, £100 a month, setting up as a standing order to your current lender and paying that down. Again, there's calculators and things that I can link, and you'll be able to see by putting some figures in your current mortgage, paying an extra £50 a month, how much interest that saves, because it's astronomical, and to be quite honest. So this is how a mortgage interest works. Some people know this, some people don't, but essentially it's not like a personal loan where you pay a bit of interest, bit of capital. You actually pay for about the first 2/3 of your mortgage term. You actually pay a significant amount more interest than you do capital, as it kind of shown there. So you're paying pretty much, even though your payments stay the same if you didn't change anything over the term or over the fixed deal period, you're essentially paying a lot more interest up front. And then towards the last third of your mortgage, you'll notice, if you look on statements and things, that your interest will start coming down, and the amount of actual outstanding capital, the debt that you owe, will increase drastically. And then towards the last couple of years, you're pretty much paying all capital then and paying it off. So a few different reasons why lenders do this. Partly they want interest up front, but also this is where making overpayments onto your capital can really speed this process up as well and compound it. So it's just one to note really, of how they work. Next is your credit report. So whether you're a first time buyer, home mover, some people have looked at credit reports, people don't understand them. It seems to be a bit of an anomaly. Credit reports, first thing is check it. Again, I'll put a link in so you can, a way of doing this. Checking it just means that, again, you're in control. You understand what's on your credit report. And especially if you're a first time buyer or even looking to remortgage, or you're renting and wanting to, and you've owned previously and gone back to renting and now looking to purchase again, whatever the situation is, it's important to understand what it is, because it's almost a bit too late by the time you find a house to check your credit report at that point. If you can check it at least a couple of months before, it means any discrepancies that are on your report that might not be your fault, you can look to try and get amended, because they're not very fast at updating, and it can take 8 weeks for your credit report to update. Ironically, they're a little bit faster at updating for the negative than they are for a positive. So if you improve it, they're quite slow. If something goes on your credit report, like a late payment, you're in arrears or default, they usually register a little bit quicker. So if there is something on there that you're not aware of, firstly, you want to be aware of it. And secondly, you want to make sure that you can amend it as well. So what affects your credit report? So firstly, are you on the electoral roll? That's quite an easy one, like registered to vote. Are your addresses all marrying up? So if you lived at a couple of addresses, make sure your bank accounts, any loans, credit cards, car finances are all registered to the same address under the same name. I've even had situations where I've had clients that are, for instance, she had a name as a title as doctor on some things, miss on some things, and Mrs on others. And the credit report couldn't quite figure it out, and it was a credit report was kind of hindered for this. As soon as we switched it all to a preferred title, a few weeks later, a credit report started going up. So it can be as basic as that, making sure names, date of births, and things are also correct. There's also financial associations. So if you're with somebody who has a lower credit report and you're linked because you have a shared bank, shared credit card, mortgage, it can actually pull yours down, or the vice versa, it can pull theirs up, which can be beneficial as well. So checking financial associations, checking if you've got late payments, checking if you've got any adverse credit at all, if you've had defaults, bankruptcies, all of this will show on your credit report. So there are a few things to look out for, and how they kind of work and how to fix it as well. Really, time is the best healer. So the sooner that you can figure it out and see what's on there and then amend it, the sooner you're going to be in a better situation. So when you come to looking to buy a house or even just financing something, you might want finance on a car, because everything runs a credit check. If it's a hard credit check, you want to make sure that you're not getting rejected for things as well. Couple of other last points really is having a credit card is beneficial if you're paying it off and settling it all the time. If you've got any credit cards that have been sat there years that you don't use, you're probably better off just closing them. And a few other things that can be useful to have on there, other than making sure names and addresses and things all matched up, is if you've got no credit at all and you're trying to build it up, if you can get a credit card in the first instance and making sure that you are paying it, and you're only say paying the fuel off to build up a report, because it's essentially a record of how trustworthy you are. So if you wanted to lend money to a friend and you knew them very well, and every time you lent them money, they'd lent it you back, you'd be thinking, okay, it's pretty trustworthy to do so. And that's how lenders see it. If it was a complete stranger that said, can I have £20, and you lent it to them and you don't really know how you're going to get it back, you're probably not going to give it to them in the first instance. So this is how it works. So this is what a kind of front page of a credit report essentially looks like. You're looking at what the score is, which, to be honest, I wouldn't take too much. I'd take the score itself with a pinch of salt. Things like ClearScore, free credit agencies like that. Lenders don't use those, so even though it gives you a very, very vague idea, they just don't use them. So you might as well look at using the main four that I'll show you in a moment, or the main three typically, which are Experian, Equifax, and TransUnion. They're the three main credit reference agencies. And then, like I say, the score doesn't really make much of a difference. Lenders don't look, when we're applying for mortgages, what the score is. They purely just look at what makes up the score. So is the defaults late payments and things? And I've had some people with quite low scores just because they've not built up much of a credit, and we've got the mortgages. And sometimes you've had people with higher scores, but they've had defaults and lenders criteria that then they're having to wait a couple of months so we can get those amended to be able to get them sorted. So don't worry too much what the score is, more worry about what the contents of your report actually looks like. And this is an example of what the actual contents could look like. Obviously, for obvious reasons, I've blanked out all the information, but you've got Equifax, Experian, TransUnion, and on the left, it'll tell you what the amount is that you purchased it, what was it for, when was it opened, who's the account holder, the address. Again, these are things to make sure they all match up across the board. And sometimes you might have something that shows with Experian that's not shown with Equifax, and different lenders check against different credit reference agents. So the credit reference agents that I use as a financial advisor just checks them all, because then we've got a broad brush to be able to check them all out. And then you'll be able to see at what point in the month have you missed a payment or not, if you have. So the bigger picture here on the right, you'll be able to see that there's number 1. That means that there was a missed payment on that. It essentially goes 1 all the way up to number 6. So if you see 1, 2, 3, 4, 5, 6, and then it typically goes to a default, and that's where it goes red. And then a few defaults can then turn into a county court judgment, and then it starts getting a bit more serious at that point. So one to note as well, if I just jump back a couple of slides, just because I didn't mean, or a slide, at the bottom here as well, you'll see it'll say payment history, electoral roll information, linked addresses, search activity at the very bottom. They're in the positive for you. And then if any of these underneath that are slightly grayed out, which you've got court information, debt arrangements, insolvency records, if any of those were showing and you were not aware of them, you need to get them checked out. If they are actually showing on there and you're aware of them, then it's, again, time is the best healer. Typically things stay in your credit report for about six so years before they drop off, and then they're just no longer included. So yeah, so that's your credit report as a whole. It's worth checking. And then now we're just going to go on to wills and what they do and what they're for. So a few key things is, most people think, do I need a will? Because one, I'm either too young, I've got no money, I've got no one to leave any assets to. Well, in a lot of circumstances, it's still worth having one. Now, the purpose of it is to leave your estate to who you want to, and to also express your wishes. So there's things as like, do you want to be cremated or buried? Is there certain gifts that you want to give to people upon you passing? But also, it's not only just carrying out your wishes, it's also planning out so that anybody that's left behind has a clear understanding of what exactly needs to be carried out, so it can prevent feuds and arguments in families and things as well. Now, for people that are younger that say, well, I haven't really got much assets yet, I haven't built anything up, so I don't really know why I'd need one. Well, a key one is if you've got children. A massive one is what's known as a guardianship clause that fits within a will. It's just a part that fits within the will, so it's not like a separate document. It goes very much within. And it means that if something was to happen to both parents, what happens to the children? Because if you don't have a guardianship clause, the state will decide. And let's be honest, we know how great the state are, the government and the actual state government at making decisions like that. We don't really want them to be making decisions on your children. So this will put in place so you can make sure exactly who you'd want it to go to as part of your will. So even though you might think wills, like, is it all financially related? No, there's other parts to it as well, which are quite key to making sure they're right for your situation. So yes, everybody needs one. Lasting power of attorneys is, or what is it essentially? Well, a lasting power of attorney is if you were mentally incapacitated, who's going to make the decisions for you, whether that's for health or welfare, because there's 2 types of attorney. So let's talk about the health side of things. If you were in a situation where you couldn't make financial decisions because you were mentally incapacitated for some reason, who's going to look after those things? So it means that you can appoint someone to make those decisions on your behalf. So that could be a spouse, it could be a brother, family member, or somebody that you're extremely close to, don't have to be related, that can make those health and welfare decisions for you. It can also mean that if you put it in place before you have the onset of dementia or Alzheimer's, it means that someone else can make those decisions for care, what the care arrangements are going to be, and what the actual lifestyle of that person's going to look like, because they're no longer able to. Then you've got the welfare, the financial side of things. Financial and property means that person, whether it's the same person or a different person, could make financial decisions. So it could access their bank account to be able to pay things for their bills, the property bills, the mortgages, whatever it might be on their behalf. And it essentially just means that you have it all put in place, these 2 different types of attorney, and they're not activated until a doctor that you're no longer mentally capacitated, and then they become active, and then they're in force, and then that person that you've appointed can make those decisions for you. So it doesn't make any difference why you're alive or why you're not you're sound of mind. It's just a fallback to make sure that could happen. So if you have a spouse that you think, well, or partner or somebody that you live with, you thought, well, if I'm gone, they need to be able to still access things and do things. That can be one reason, which is very much the same reason why you would you'd have one put in place. You want to make sure that they're looked after. And then last bit, when would you set one up? Straight away, really. As soon as you can. The idea of setting one up, some people don't know what they are and have the discussion sometimes when they either come across paths of the financial advisor or when they're getting a will set up. Some will companies will do this as well. It's worth having done, ideally at the same time you get your will written, but if you get this put in place, there's no right or wrong time because it doesn't change anything. It's just that backstop for when things become unchangeable. If you're mentally incapacitated, at least it was in place. And you can do this, you can do yourself through the government websites. If you know how to do it, you do it right, it can be fairly straightforward and they're not too expensive at all. But again, you can get help with arranging that. So that is the sort of crux of what I wanted to cover off and what the masterclass was all about, really. And then we've sort of built upon, firstly was the budget, the actual emergency fund and how that works, insurances, retirement plan, investing, mortgages, wills, and lasting power attorneys. So if you can do them in that order, ideally, I appreciate people have got mortgages and things and it's not all so clean cut. But if you're thinking, where do I start with things? Start with the budgeting and the emergency fund first, and then build the rest up on top of that as well, and it'll set yourself in a really good pace. So hope that was helpful, and I'll speak to you all soon.